Thanks for joining us on another For Investors by Investors South Bay podcast. As always, we are proud to be your all-education real estate investment resource without any kind of sales pitch. If you would like to attend one of our meetings in person, we meet the second Tuesday of the month at the Manhattan Country Club in Manhattan Beach, California. You can RSVP at forinvestorsbyinvestors.com/South Bay. To find more investment resources, such as blogs and podcasts from other FIBI groups, go to forinvestorsbyinvestors.com and search our library. Now, on to the podcast.
Thank you guys for joining us today. We really appreciate it. Who's here the first time to a FIBI event? Okay. Thank you guys very much for coming. I appreciate it. You guys can pay me your $16,000 for the boot camp we'll sell you at the end of this if you want. You know, it's no problem. I'll have checks right out to Owens Consulting Group. We're good to go. So, yeah. There you go. I'll finance the rest at 15% too. If you want. No problem. So,
I'll beat that at 10.
yeah, there you go. We got a hard money lender with no collateral right here. So, well, thank you guys very much.
What you mean? Did it take my first towel?
Yeah, there you go. There you go. The first child. That's perfect. For Investors by Investors, or FIBI for short, was actually put together by Jeremy here, one of the panelists, as well as another investor by the name of Ellis San Jose. That we're tired of going to networking clubs and getting a pitch every time. The boot camps, the book and tape sets, you know, the speakers selling something in the room, and so that's where FIBI was formed. They wanted to have a place where people could go, get the networking they need, develop the relationships that they need to do this business, and not have that sales pitch involved, and get true education without the sales pitch. And so FIBI was formed. I started FIBI Long Beach afterwards, and then we started FIBI Manhattan Beach. We have FIBI Orange County and Pasadena now, and FIBI Women's Investment Network as well. And so we have a number of different chapters, about 13 chapters throughout Southern California, and we have about 22,000 members now at all different areas of Southern California. And we have a couple of out-of-state as well that are smaller groups. But basically the whole basis behind the club is no sales pitch and real estate education and networking without that pitch involved. So at any of our clubs, you guys can find us at meetup.com and type in FIBI. You have to change the search criteria to like an unlimited area, and you can find all of our chapters. Or you can go to forinvestorsbyinvestors.com and find all of our chapters that way. We're also recording the podcasts and things like that that's downloadable on our site as well. So if you guys missed something, want to go back and check something out or what somebody said, you can feel free to go check those things out on our website as well. So that being said, that's a little bit about FIBI in a whole. Dave will tell you a little bit about this club specifically.
How you guys doing? Good. Well, thanks for coming. We always, it's like having children. We always say that, look, all of our FIBI panels are special to us, but this particular panel, when I would tell people about it, it's like if you're going to come to one FIBI panel a year, this is the one to come to. Because I think from an investor standpoint, having a good feel of where we're going economically, having a sense of where we are in a cycle is so important when you're looking at a potential investment, or whether you're looking to buy something or sell something. We've been blessed to have three great panelists. This is the fourth time we've done this, just with the three of you. Yeah. We've had these same three guys for the last 3 or 4 years, and they are as full of shit as they always have been. I mean, everyone has an opinion, right, on the economy. So, but no, we really feel blessed. We've got three people here that have a diverse background, but they all have some kind of eye on the economy and where things are going. So tonight we expect to have a really great panel. We do have a bunch of questions that we have pre-written, but we encourage you to raise your hand. If you've got a question on something, please raise your hand. We'll get to as many questions as we can. If you have a question on something that we're going to cover a little later on, we may ask you to hold that question, but feel free to raise your hand and ask any questions that you guys have. If you've got a very personal question, save that towards the end, right? Because once we're all said and done here, these guys won't even be able to make it through this door, let alone that door, without being bombarded with 20 people wanting their business cards and asking them questions. So if you've got something that you want to ask that's very, very personal about your situation, find them after the meeting, or more importantly, grab their card and give them a call, and we can set up an appointment and talk about something later on. The panel that we have in November is going to be posted up tomorrow on meetup.com. We've got 4 amazing speakers. Actually, you know, Matt's a pretty active fix and flipper and joined a group about 4 or 5 months ago that's gotten him in touch with some really sophisticated people in his industry. We've got 4 of them that are speaking next month. The topic is how to market to find a real estate deal, which, as you know right now, there's not a lot of deals out there. So having you know, some sophisticated looking at how to different techniques from marketing to find real estate deals we'll be talking about next month. So you should get an email in the next 24, 48 hours announcing the November panel. The date is November the 8th, and it'll be right back here in the Manhattan Country Club. Also, who here has been to the all-chapter networking meeting with FIBI? So twice a year, as Matt mentioned, we have multiple FIBI chapters. I think we currently have 7 or 8 that are active. We've got, I believe, over 14 or 15 total chapters, over 23,000 members within FIBI, mostly here in Southern California. And twice a year, once in the spring, summer, and once over the holidays, we get together and do we all kind of co-promote one big networking group down in Long Beach. Unlike this, where we have a panel and speakers, that meeting is pure networking. I mean, I think we get up and talk for about 15, 20 minutes and just talk about FIBI and the different groups that we're in. But for the most part, it's just the networking environment that you had when you first walked in. So that meeting is going to be December the 1st, and the meeting notices will probably be going out in the next 2 or 3 weeks. But once again, it'll be down in Long Beach, where Matt runs his group, the Long Beach FIBI group. So keep an eye open for that. You know, we have, this is a big group for us. You know, part of running FIBI for Matt and I, it's not to make money. You know, this is we definitely consider ourselves a not-for-profit. If anything, we're probably a for-loss group. You know, obviously you're paying $20, $25 to get in here, so we're not here to make money. The way we do keep this thing going is by getting sponsors. We have a couple of amazing sponsors, some of which are here tonight. Actually, Jeff with UDirect is back in the back there. UDirect IRA does self-directed IRA, so if you have any questions on the self-directed IRA space, we recommend you talk to Jeff. Is anyone here from Farmers? Oh yeah, good. So we've got Richard, right?
Randy.
I'm sorry, Randy. Randy's with Jesse Navarro's group, which is based down in Redondo Beach, and besides doing you know, fire and casualty, they also are the group that we're talking to about insuring our FIBI group. So they do a wide range of stuff. So if you guys have any insurance questions, talk to Randy and Farmers. I believe we have some attorneys here from Spiro Woodward, correct? Yeah, of course. There you are. So Spiro Woodward has, they're a really large attorney firm here in the South Bay, have been around forever. Stephen Spear has actually been a panelist, as has Melanie, as has Joe. I think we've had the whole Spear clan at some point in time over the life of FIBI. So good local firm. If you guys are, you know, in need of any real estate advice from a legal standpoint, recommend you guys talk to Spiro Woodward. I know Kyle Mealy's not here because the tax deadline's a week away, although, I mean, you made it. Kyle's slacking, so the name of his company is SBTC Consulting. They're based out of Hermosa Beach. They specialize in doing real estate and small business stuff, so if you need any advice from a legal standpoint, or from an accounting standpoint, we recommend you talk to Kyle. And by the way, all these people have cards in the back, so if you want to grab something at the end, you can do that. Joe Klima is a commercial lender, Klima Financial?
Klima Capital.
Klima Capital. They mostly do lending on commercial properties. And then lastly, we have More Financial, which is a hard money lender based in downtown LA. They do a lot of private money loans on real estate. So we really appreciate those guys because that's what allows us to do this and only charge you guys $20, $25. So thank you for allowing us a few minutes to thank them. All right, so we're going to get started here. Actually, one last announcement. Tyler wanted me to let you guys know that if you had if you paid in advance, or if you have a season pass and you didn't check in at the front desk, just make sure you go check in at some point in time, just so we know that you're here. So if you already paid, or if you paid in advance, you don't have to pay again. We just want to know how many people we have. So Tyler asked me to mention that if you are to go check in.
Sorry, who are you?
We'll get to that. So we're going to start off with introducing our panelists first, because we're gentlemen. So we've got 3 panelists here, and Steve, why don't you take the mic first?
Do I get to take the mic, or do I
Well,
get
so
to turn on mic?
Well, turn on the mic, yes.
Okay.
Does that work?
Okay, cool.
Well.
That's kind of weird because like I'm used to holding the microphone and now I get to hear myself amplified. It's very strange. Does this what I sound like?
Yes.
No wonder my wife doesn't want to hear me talk. All right, so my name is Steve Carvel. I'm a wealth transfer and tax attorney. So let me explain what that means. It means I represent really wealthy people in transferring.
Can move it down.
I should move it down a little bit.
Yeah.
Okay. See, this is what I wanted to do. Not right there.
That's good.
Okay. Now I sound normal. So I'm a wealth transfer planning attorney. I represent very high net wealth individuals in transferring property from one generation to the next. Are we gonna keep going?
We're gonna
Okay.
fix it.
We're gonna fix it? Okay. So I get to see a lot of really interesting transactions. I get to represent a lot of individuals who are presented with unique opportunities, and I get to represent a lot of individuals and families who are attempting to develop opportunities. I've seen a lot of cool stuff this year, and I want to talk to you guys about that as we go along through the night. But as a lawyer, I have a few things I have to say and a few disclaimers. But first of all, I want to say thank you to the FIBI team for inviting me to be here. This is my 4th year. I see a lot of familiar faces around, people that I've seen before, people that I've known outside this organization. I'm told this is one of the biggest nights that FIBI has, which I think is pretty exciting that I get to be part of this. FIBI is a really unique and special opportunity that all you guys have. I think it's, at least to my knowledge, I don't think it's very common that people in other markets have the opportunity to go and meet like-minded people, share ideas. And I think what it does for you, and I think what it does for me too, is it sort of flattens the learning curve. Matt and I were talking earlier about the opportunity to talk to people who have had experiences in this area and smart people who have sort of learned, and people who've learned in the School of Hard Knocks. So if you can avoid the School of Hard Knocks, you definitely want to. So specific disclaimers. Number 1, tonight's not going to be politically correct. All right, you've probably seen all these panelists before. You know that we're going to call it like it is. We're not going to worry about triggering people. We're not going to worry about people's feelings. If that's going to offend you, maybe this is not the event for you. Number 2, they made me finish the bottle of wine before we came in here. Allan's drinking water, as you can see. And Jeremy is not drinking anything, right? So that means that my answers are going to be the most unique, fun, and interesting. So don't pay attention to anybody else. Number 3, nothing I talk about tonight is specific legal advice for any of you. I wouldn't even listen to me, okay? So that is what you need to understand. It's being recorded right now. Nothing that I can say, or that I'm saying, is going to be applicable to you or can be held against me. Number 4, I forgot this was tonight, so I was wearing athletic socks before I got to my office, and I'm not even going to try to hide my hairy ankles from you guys. So I'm going to be comfortable while I'm up here.
But by the way, this is why we stopped videotaping these things. Because you've got ankles made for audio.
That's right. And number 5, over the 4 years that I've done this, I have slowly crept from that side of the room all the way over to this side of the room. I'm going to tell you why. Because I get to answer the questions first, right? So that way no one steals my answers. All right? Those are my disclaimers. Thank you very much for having me tonight.
That's the most rehearsed moment we're going to have all night, just so you guys know. Allan.
Yeah, I'm Allan Hamilton. I work for a large mutual fund company. I'm an analyst there, a developer analyst. See a lot of interesting things go past my desk. I was educated at the University of New South Wales in accounting, finance and systems. And I'm a local landlord in Long Beach and some apartment buildings in Long Beach. And used to do HUD flipping back in the day, but not too many flips in Long Beach right now, except for Christy, she's doing a few. But yeah, stay up on economics pretty closely.
Cool. Jeremy.
Is this working? Okay. Yeah. Okay. Just want to thank everyone for coming today. My name is Jeremy Roll. As David mentioned, I'm one of the co-founders of FIBI, which actually we started back in 2007, so it's going to be 10 years next year. And actually, I just want to remind you guys that the meeting you announced for next month for here is, I think, on election night. So I swore that we'd talk about the elections tonight somehow, so that was my segue into the elections. But just keep that in mind. I don't know if you want to change the date. Anyway, so I'm originally from Montreal. I call myself a full-time passive cash flow investor, so I got out of the corporate world back in 2007 thanks to investing passively in various cash flow investments, mostly commercial real estate. And so since 2007, my primary focus has been on continuing my cash flow streams. I never have to go back to the corporate world. Hopefully no one I ever used to work with in the room and I'm not offending them. I also manage a group of investors who are looking for similar passive cash flow type investments that I look for. I'm currently invested actually in over 70 different LLCs, but it's because I've been doing it for about 15 years, so I'm just very diversified. And I invested in all different types of things, and not just even real estate, like ATM machines and cash flowing websites and a couple startups and some other stuff, but primarily stabilized passive cash flow and commercial real estate. What else can I tell you? Thank you again for coming, and for those of you able to make it, the event we have on December 1st, the All Chapter event, should be a really good one too. So,
Thanks, guys. Appreciate it. And just for the record, if you guys want to come and listen to honest people on election night, you can come here. If you guys want to actually go through and listen to a bunch of criminals in the media, then, you know, stay at home on election night. So that being said, I'm a California licensed CPA and a full-time investor. I've flipped a little bit over 500 houses. We flip about five houses a month. We buy apartment buildings. We invest in a lot of Jeremy's deals and other outside syndications. We invest in promissory notes, and I've been doing this for about 10 years. I quit my CPA firm job doing that in probably the worst, or you can consider it the best possible time to jump in 2006. Right before the crash happened, so I was like, oh, there's economic cycles, much fun to deal with. So, but you know, getting in at that time, it's very interesting. You know what happened at that time. There's tons of amazing deals that happened. There's a lot of opportunity in every cycle that we're in. So, I suggest everybody in the room, as they listen to some of the different comments and commentary, really focus on what types of investments you should be investing in now, based on some of the economic indicators that, you know, we'll be talking about up here in some of the different discussion that we have. Instead of worrying about, you know, crashes and things like that, pay attention to those things, but invest in the right asset classes to protect yourself.
Great, my name is David Coe. I am a licensed California real estate professional. We help families in transitions. We work with a lot of investors. Actually, my partner there, Gloria, has already yelled at me for not introducing myself. We're a local Keller Williams team located right across the street. I'm also a full-time real estate investor and started off fixing and flipping houses. Had no idea that markets had cycles, and it wasn't until I went to one of Jeremy's FIBI meetings close to 8 or 9 years ago that all of a sudden, like the bigger macro picture of investing affected me. So for those of you that are here for the first time, or a couple of your first few meetings, coming to this environment, sharing like-minded ideas with like-minded investors is terribly important. So not just getting a chance to network with us, but there's a lot of brain power in this audience. So make sure you spend some time meeting people. When we're done, don't get up and run out of here. You're missing out on the best part of FIBI, which is literally talking to the people around you. Throughout the course of the evening, people are going to ask questions, right? And you're going to say, okay, if they're asking that question, that's maybe someone that I want to connect with. So make sure you take a mental note, grab their card, and find a time to talk to them after the fact, because it will change. It will change how you invest. So, okay, so we're going to get started here, and actually we're going to switch things up and start from the outside and work our way in.
Can I pass?
All right, so the first question is, obviously we're here to talk about the economy. We're curious to kind of get a sense of what type of economic data do you guys follow. Steve, talk about the type of stuff that you follow, who you like to listen to, who you like to read.
So I'm constantly scanning for data. There's no one source that I think is the best source, but I think the best sources to listen to are the sources that are sort of independent. I'm a big fan or a big believer that whatever you're into, whatever your thing is, if you ever see someone in the media write about it or propose or purport to be an expert about it, they don't know anything about it. People in the media are professional pretenders. You have to sift through all that data, you have to analyze it, you have to apply your own life experience to it. I'm not a big believer in the information that we're fed in the mainstream media. I'm not a big believer in the information that we're fed by the government. So aside from sounding like a conspiracy theorist, I think there's better information out there. We used to, some guys are smiling over here, right? So we used to have these formulas and definitions of what things meant. And then as those didn't make sense to our elected leaders, they changed the definitions, they changed the formulas, right? There are companies out there, websites out there that put out statistics and put out other information, like shadow stats. I'm sure some people have heard of shadow stats. I see people nodding their head over there. I kind of just take it all in and then I apply the smell test to it. If it makes sense, I kind of apply it, and I apply what I know, and I apply my own experiences to it. So I'm not giving you a definitive answer other than I kind of take it all in and I sift through it and I take what works for me or what I think is correct and I discard the rest.
Allan, what do you say?
Yeah, so on the economics, I think the best site that's out there is Michael Shedlock's Global Economic blog. It's very, very up to date. It's free. It's, you know, he goes in depth in these economic indicators and what Steve was talking about and how they fiddle with the books, so you get a better idea of what's really going on. But he gives a very good summary of what's going on. So Michael Shedlock's first two initials, his first name's M-I, Shedlock is S-H, so he goes by Mish. So it's actually mishtalk.com. And I think that, I mean, I read a lot, but I think that gives a very, very good summary. Back in the day, in 2007, calculated risk was really hot. And, you know, right now, it just gives basic information. And then on the real estate side, John Burns Consulting has a free email, which is pretty good. They go over demographics, they go over building in different markets in Texas and things like that. And the free newsletter is pretty good. And then I like Doug Casey Research as well. Doug Casey Research also has a very good free newsletter that comes out once every 2 days. And they cover some interesting topics.
Jeremy?
So, going back to Steve's point, I think that the most important thing with data is to understand what you're looking at and to understand if it really is what you should be looking at. And that's the trickiest part, I think, right? So we could take a look at like the unemployment numbers that the government likes to use, and there's so much that it doesn't show. It doesn't show what types of jobs people have, whether they have full-time or not, whether they want full-time or not, the people who are working. Is it that really, there's different ways to look at the unemployment rates. They may have changed the definition over time. If you look at the way that it used to be looked at a more full picture, it's a whole different story. I mean, I'm just using this because everybody understands it. And so it's not just important where you get the data, but really what you're looking at, to understand what you're looking at. And I actually think shadow stats is a good one to go to if you haven't gone there, because if you think that the inflation is really 2 or 3% or whatever they're publishing, it's amazing the difference. As an investor, your job is to basically at least hit or beat inflation. And if you don't even know what the real inflation is, you can't even know what you're trying to hit or beat. So it's really important to really kind of get through the weeds of the media and look at the pure data and make sure you're looking at the right data. And so with that, I think that Calculated Risk blog, I like it just because what they do there, and I find them a little optimistic, but what's really good is that it's very objective, and that's what you really want to try to find. The data is objective, it hasn't been massaged, it hasn't been twisted and turned. And so Calculated Risk blog is good because they just republish the data of the day. And they do give a bit of a commentary on it, which I do believe is a little optimistic, but still, at least you can find it all in one place. The challenge with it is that you still have to be careful what you're looking at and understand really what you're looking at. Another one that I like is Zero Hedge, which is extremely pessimistic. So I've given you one optimistic and one pessimistic one, but again, with Zero Hedge, if you're able to kind of eliminate half the articles that seem too pessimistic to you and read the other half, which are just showing charts and data, as long as you understand the data and make sure it's the right data, it's a really good source as well. And then personally, as an investor, I always try to gauge consumer sentiment. The real estate market, the stock market, all that can actually turn on sentiment. And so to really understand sentiment, you have to look at what the media is putting out there. So I like to look at CNBC, Drudge Report, and a couple others, Business Insider. Business Insider is actually really good because they tend to show both sides, whereas some of the other ones are more biased one way or the other. But those are other good places to see what the media is putting out to understand what consumer sentiment looks like.
Allan, Jeremy talks about some of the stuff that as far as the types of data he likes to look at. What about you? Like, what are the types of things from a real estate perspective that you like to follow that you feel have the greatest impact on real estate?
Real estate's about jobs at the end of the day, right? So a starter home in San Francisco is now going for $1 million. The average home in San Francisco County is 1.3. So now the reason why that market is so out of control is because the jobs in San Francisco are better than anywhere else in California. Part of that reason is the best minds in the world are working on driverless cars right now, right? So there's the best engineers in the world are in Silicon Valley, and they're trying to figure out all the problems with driverless cars, right? So one of the problems is snow reflects light, so if the snow throws out driverless cars. So that being said, I think San Francisco is clearly in a bubble when you start seeing stories about people renting out their front lawn for $300 so somebody can put a tent on there. That doesn't scream bubble, I'm not sure what does. But you know, it's going to be pretty sad if you make $150,000 a year and your wife made $100,000 a year and you couldn't afford to start a home in a certain county. But you know, at the end of the day, real estate's about jobs. So job information is very important. GDP, gross domestic product, is the Cadillac of economic indicators. I like to look at the Dow Jones too. If you look at the Dow Jones Industrial Average, it hasn't really made any progress for 2 years. It keeps coming up, falling, and then coming back up, but it's in a major topping pad. So Jeremy was talking about consumer sentiment. One way to gauge consumer sentiment is just straight from the Dow Jones Industrial Average, because that shows you how bullish or not bullish people are. So right now, we're not making any headway, but we're not losing anything either. So we're basically in a 2-year topping process.
What about you, Steve? What do you like? From a real estate perspective, what do you find most informative?
I think perception, right? So I think perception is what's driving the real estate market here. And perception, whether it depends on a property's an appropriate purchase or whether you feel like the property's going to go up in value or not go up in value, I think perception is probably the hardest metric to gauge, but I think it also is the most accurate in terms of weighing all the various factors that you have to consider and develop and figure out where something is going to go. Because at the end of the day, something's only worth what you can sell it for. And if you can't sell it for what you think it's worth or what you need to sell it for, then it's a loss at that point in time. So I think perception is the most difficult, but probably the most, if you can peg it, accurate.
Allan turned me onto a site that I thought was absolutely amazing. It should be a requirement for every person in the entire world to listen to, which was peakprosperity.com. And there's a crash course on there that's made up of about 20 to 25 little 5 to 10 minute videos about every major issue that is facing our economy right now. It may be a little dated now, but at the same time, it's literally one of the best overviews I've ever seen when it comes to the economy and the market and things like that. And I recommend everybody here go and take a look at that. It's like, what, $35 a month or something like that to be a number.
Actually, the crash course is free.
Oh, the crash course is free.
The
Okay.
crash course.
Find it on YouTube.
Oh, you can?
Yeah.
Okay,
Yeah.
great.
Find it on
Yeah,
YouTube.
check it out. I mean, have your kids watch it. I mean, literally, it's amazing. So, and I think that's really, really key. And I think what Steve was saying is very, very important with regard to what information you're reading and who is putting it out there, of course, right? I mean, if it's out there, it's probably paid for most of the time. It's one way, shape, or form. And Jeremy, when he was doing his meetup up in West LA, he would go through a stack of papers like this, and he'd show multiple articles about the same topic with completely opposing views, showing what is reality and what is fabricated about what's coming out and why. And I think that's really, really important to understand what you're reading and to understand that, question everything that you're reading in detail, especially on the market. I mean, you talked about, inflation and, real unemployment and things like that. And so, I think that aspect of things is really important too, because we're getting a lot of false information because it's in the government's best interest to keep everybody on this little floating cloud so that everybody thinks that everything's going to be running okay, and it's important to understand where they're coming from with as far as consumer sentiment and things like that, to be able to realize that, hey, they have an ulterior motive here involved to keep that economy running, and they want everybody feeling like everything is perfect. And so, that the next question we kind of had was elaborating and having you guys give us your take.
Can I say something on that? Just
Yeah,
to
please.
piggyback? I think, as real estate investors too, you have to always keep in mind that prices are set at the margin. So if you're in an area like San Francisco where starter home is $1 million, as long as those starter homes are going for $1 million, then your starter home's worth $1 million, right? But if right now, as we speak in San Francisco, in 6 counties around San Francisco, the number of sales have dropped by 10%, the price has dropped by 3.3%. So what happens is everything is priced at the last comp. So if you get you're in an area and you get 2 or 3 comps where it might be down 5%, then everybody's down 5%, right? It doesn't take much to move a market, and so we need to remember that, right? Because when you're in a bull market and everything's going up, it goes up slowly and it goes up over a long period of time, right? So in real estate, the bull markets last between 7 to 10 years, right? But a bear market lasts from 4 to 6 years, but it's a lot more vicious, right? Because that's what happens, right? So I think it's important to remember that, right now the Federal Reserve is trying everything in its power to create some form of stability, but that stability could be interfered with very quickly.
And so far, the Federal Reserve has pretty much created this, lack of stability so far. That's pretty much what they've done throughout history. So,
right, because then the next time there's a recession, and Jerry, we'll talk about this later, but in March of next year will be 8 years in the United States without a recession. Now, the United States is doing better than any other major country, but we've gone 8 years without a recession. On average, it's 5.5 years since World War II. So we're, basically we're building up all these, imbalances, and the Federal Reserve has the Fed rate set at 0%. So next time there's a recession, what are they going to do, right? They're scared, witless that they can't that they want to raise rates, but they can't raise rates.
they may play with the negative interest rates we see in other countries.
Right. But negative interest rates are it's very important to understand. Like even 3 years ago, if you said there were negative interest rates in Switzerland and across Europe, people would say, well, you're crazy. What is that? Okay, so negative interest rates is you pay the government of a country to hold your money, and then they get to charge you money. If that is not a red flag, what is a red flag? Right? You literally have to give them the government money to hold your money, so you get nothing. Right? So there's $10 trillion of negative interest rates. I mean, mainly in Europe, but $10 trillion is a lot of money at negative interest rates. Now, if interest rates were to go up, all those people that bought in at negative interest rates would all lose money. They'd all lose money. So if you've got major corporations with trillions of dollars and interest rates go the wrong way, there could be severe losses. Right now, the economic blogs you probably know are just alive with talk about Deutsche Bank. Deutsche Bank is now talked about as the single most dangerous bank in the world. It has a 25 to 1 leverage ratio. They're being fined, $12 billion for doing nasty things when they've only got $67 billion in equity. So Deutsche Bank, the Prime Minister of Italy, actually threatened Angela Merkel that he was going to out them for how economically unstable they were unless Germany helped bail out the Italian banks that are bankrupt. So that's a pretty unusual.
That's crazy.
Yeah.
You have a question in the back.
Can I just make a quick comment first? I'm just curious, to show of hands, how many people here know that there are mortgages that exist in the world that are negative interest rates, meaning they actually pay people to have a mortgage each month instead of you paying an interest rate? How many people have heard of that in the room? I'm just curious. So like just a few. Yeah, I mean, that's something else that comes along with it. Like literally they pay you to take out the loan each month, which is really odd, but that's how desperate some of the countries are right now. I think Norway is one of them, I think. And you should go research it. It sounds insane, but it's actually real and in first world countries right now. And so if you're trying to sort out where things may be going, I mean, if we end up with negative interest rates, which is not impossible, that actual scenario is actually not impossible. You can be in the US and they can be paying you to take out a mortgage. I'm not saying I think it's going to go there, but it's something you should probably be aware of or just research more in case it ends up there. So.
Do you have a question?
So you might have a question. Do you believe
See, you can't, if there's a mountain and there's like this, all these rocks on the side of the mountain, and the geologist says there's going to be a seismic shift on this mountain, and the mountain's going to come down, right? So these guys drive past the mountain for 10 years, and they go, oh, you know, the geologist doesn't know what he's talking about because I've driven past here 10 years. One day a bird just drops on one rock and the whole thing comes down and kills everybody on the road, right? So when you're in a complex, chaotic system, it's very, very hard to say, okay, this system is going to break down at this point in time because the complexity in the system is so great. And that's what we saw if you watch the movie The Big Short, which was up for Big Picture of the Year, is you see the instability in the system, and anything could be a catalyst. It could be a bird dropping on a rock, it could be somebody sneezing, and the whole thing can come down. Now, I believe there's going to be another movie called The Big Short Part 2, and I believe Deutsche Bank is going to be featured in that movie. Yeah, well, interest rates, what, 40% of the nations have negative interest rates in the world right now? Yeah, the derivative position of Deutsche Bank is greater than the GDP of Germany, and Germany is the strongest country in the EU, and it's not that strong.
So after the mountain analogy, who wants to take a shot? I'm like, great.
So, Jeremy, let's talk about the U.S. economy in relation to the rest of the world. I mean, obviously, you know, it seems like we've been on borrowed time here for a while, but I know that, you know, compared to the rest of the world, you know, we seem to be one of the more stable economies globally. How does that affect, you know, from your perspective as an investor, how does that affect you making decisions about, you know, where to place money and where not to?
Yeah, it's definitely a good question. I tend to think very long term. So the way that I invest is, you know, I might invest in a deal that's going to have a 10-year horizon. So what I have to figure out is, does it make sense to do that, and is it going to be stable for 10 years, which is pretty far out. So I might be a little bit longer term thinker than what these guys are thinking in terms of how they approach things. Here, I think here's where we stand. You know, I think we're 89 months into the recovery, and that is very long. Just to put in perspective, I think we're, you know, the third longest recovery right now. Ever in the last, I think, since 1879. And what's happened is that, what's interesting about those statistics, though, is that the last 3 recoveries have averaged 94 months. So we're actually still a few months away from averaging the last 3 recoveries. So even though the long-term average is much shorter, I think recently, because of all the money printing and perhaps other reasons, that they've been able to like push recoveries out longer, and things just seem better for longer. If you look at it that way, we're just a few months off away from being the average situation in the last 3 recoveries. We're clearly going to be due for some type of downturn at some point, you know, knowing that it's cyclical. So I personally think that we'll be due for a recession anytime between now and the next 2 years. And I read a B of A study recently that used 5 different indicators extrapolating from the past that are pretty reliable. And they were saying that the range of what they predicted a recession from all those indicators would be between like July 2016 and April 2019, with the expectation that it would be in Q3 of 2017, just for example. And I looked at all the data, and it's all like pretty reliable data, so that's not a bad measure. So what that tells you is that we're going to have a recession soon, and you have to kind of plan accordingly. It doesn't really matter if it's going to be in a day or a year. It may matter to you, but the point is that you should know that there's probably going to be one coming up soon. But I think from a much bigger, longer-term picture, what I'm really concerned about is that for the last 2 decades, if you were to look at it on a chart, the U.S. has continued to get these recoveries where the debt gap is kind of going bigger and bigger. What I mean by gap is that to be able to sustain the same GDP and production in the economy, there's more and more money being printed and more consumer taking on more debt. And if you look at a chart I've had in front of me, it'd be very obvious. And if you look at our demographics, in the next 2 decades, there's going to be a huge, we were talking about this before, a huge entitlement problem and a huge pension problem and Social Security and people retiring and the rest of it. And so really, unless there is a major shift, the only solution to keeping the growth going, even as slow as it is right now, is to continue to print more and more money, because the gap's actually getting bigger that needs to be filled by the debt. And so with that in mind, from a long-term view, I think the U.S. economy is not in a very good situation at the moment. Not even referring to whenever this recession is coming up. I'm talking about bigger picture. And my bigger concern is that if we don't have a politician who actually makes a very drastic change, I don't know what's going to happen in a decade or two when they have to completely change Social Security, pension funds are going to go bust, or they're going to have to, I mean, there's going to be so many things that are, it's already starting, right? But I'm talking about it's really going to hit the wall in probably 1 to 2 decades. And I'm concerned that the politicians aren't going to do what they need to do. And the question is, where will that land us? So I'm thinking that kind of a little further ahead, and we're going to have some really major demographic issues to deal with. That's the biggest thing on my mind right now. And overlaying that with, well, what makes sense to invest in now that will actually be okay in 10 or 20 years. One thing that appears to be okay would be like retirement communities, for example, right? And I mean, that sounds funny, right? But it actually makes a lot of sense, right? They're probably in the clear for like at least 2 decades or 3 decades. So another one that I really like, I've been investing in a lot for many years now, is mobile home parks. And it's just because our real incomes, inflation adjusted, have been going nowhere. And they're not really going anywhere anytime soon. And with this bigger gap, what that does is this gap of debt actually causes the potential for the economy to basically stay reduced and the potential growth to stay reduced. And so with that, you're not going to find huge increases in incomes and all that type of thing. So those are the kinds of things you have to think about in terms of where it makes sense to invest down the road, as an example.
Steve, I'm going to throw this question at you now. In particular, you and I have had the conversation that it seems like this feeling that we're right around the corner from having a correction has been on our radar for 3 or 4 years now. And you've made the comment before that think about how much wealth has been made while we were on the cusp of a major recession. So I'm kind of curious to get your point of view now, where you think we're at and what your point of view is.
So eventually, we're going to be right? If everything's cyclical, you guys come enough years in a row, we're going to be able to say, yes, we were correct. But here's the interesting part about where we are. You guys have, being in this particular country, in this particular geographic area, a competitive advantage over a lot of other people throughout the world. And that is that the US is still the prettiest girl at the ball, right? Regardless of what's going on in the rest of the world. Unfortunately, that means there's a lot of foreign capital that's flooding here too. Last year, we all sat up here and we were sort of on the precipice of realizing that pricing is really being driven, maybe not on perception or on the economic factors that we're used to looking at here in the US, but on perception in the rest of the world and the economic factors that the rest of the world is looking at. I get calls almost every single week from people looking to move money here from foreign countries. Egypt, Canada. I see a lot of people moving money from Canada, France. The problem is that everyone in this room is competing with money that's fleeing what it perceives as risk. And it's fleeing to safety and certainty. And the reason it's fleeing here is because regardless of what goes on here or what goes on in the rest of the world, we still have probably the most certain, the most predictable economy and the most predictable form of ownership of property, and we have here the rule of law. We have the type of rule of law that we can all depend on, and that people in other countries, it's kind of funny, we don't recognize that people in other countries don't have that same certainty. They have seen their governments, their countries nationalize their property. They fear that the same thing is going to go on there. So for example, we've seen a ton of capital flee here from China. We've seen a ton of capital flee here from other unstable regions in the Middle East. It's unfortunate we have to compete against it, but it also creates opportunity here in that we're in this market. We're already here. We're not having to come from a foreign market, understand this market, make sure that we're getting a good deal, understand where the edges are, because the edges are really where you make your money in this kind of a business. So we have a huge opportunity. And it's based on the fact that we have a strong judiciary. We have a bifurcated system of government. We have a strong constitution that protects property ownership. Real property ownership is probably one of the most unattractive forms of property for the government to attack and the least convenient for them to attack. So if you're really thinking long term, we're going to see a decline globally, we're going to see a decline in the US, there probably are fewer safe havens than in good quality real estate. And the other great part about good quality real estate is it's a store of value. We see, so Jeremy was talking about the pumping, the artificial pumping of money into the economy, the devaluation of our currency. If you own real property, it doesn't matter as much as if you own other types of assets if our currency is devalued, because your property is denominated in dollars. It's what a willing buyer will pay a willing seller. The other great part about real estate is it's the store of value that kicks off a dividend. You get rents. You have productivity issuing forth from that property. Other stores of value, gold, artwork, jewels, whatever it is, they might be more portable. They're easier for governments to seize, they're easier for you to lose, and they don't kick off a dividend. There are very few classes of assets that kick off a dividend. And that's not even to talk about the ability to use leverage or other people's money in acquiring those assets. So I think I kind of wandered from the question.
Yeah, I think you're trying to sell them your books and tapes.
That's right. I don't sell books and tapes. This is just this is what I see on a daily basis. So, I get to, the coolest part about what I do, and I think I tell you guys every year, is I get to see how real wealth is built. I get to see real people who built real money. And they almost to a T all follow the same model. I've seen people who started in the 60s as second grade teachers, husband and wife struggled to get their first apartment building. They leveraged into another one, they lived in one of their units. They managed it, they painted it, they did the plumbing, they did whatever they had to do. And now they're enormously wealthy. That doesn't exist in other parts of the world. And people in other parts of the world come here and they recognize this opportunity. And unfortunately, we have to compete against it, but we have a comparative advantage to them in that we're already here. We already know the markets. We already know what's going on in Long Beach. We already know what's going on in El Segundo. We already know what's going on in Hawthorne. So, all right, I'm done. I'm not trying to sell you guys anything except for my excitement and exuberance over
It's not just California too, right? There's other states, and you got, even if the macro picture is not looking good, you've always got the micro picture. So I'm very bullish in the Midwest, because when you look at, it's a very simple thing. When you look at the cost of electricity in the Midwest, it's 1/3 the cost if it is in China. That means it's inevitable at some point that robotics is going to be in Tennessee. It's going to be in Alabama. It's going to be in Texas, where the electricity is cheap. So if you look at the states where the electricity is cheap, those states are going to do better than California. California is very, very topped out right now. I mean, a 2% cap rate, which is what all the apartment buildings go for in Hollywood, right? What that means is, if the building was $2 million, you put down $2 million, everything ran perfectly, you made 2% on your money. I mean, that's insanity, right? That's a bubble. So, yeah, the Midwest is a whole different, it's a whole different micro story than the US. The US right now, and we were talking about this before, the official government debt is closing in on $20 trillion, right? So when you take $20 trillion, our economy is $17 trillion, the largest economy in the world. 20 divided by 17 is 107%. So we know that when that number is more than 90%, the debt slows down the economy.
What's Japan at right now?
Japan's at 250%. They are the winner. They're number one.
They're actually loaning their citizens funds to purchase U.S. real estate right now. I'm dealing with some banks out there right now that are loaning their Japanese clients and citizens funds to invest in the U.S. at 0.65 to 2% 15-year fully amortized rates. It's pretty interesting. There's more money coming to this country. It's unbelievable, what's actually happening.
So I just want to add something as an adjunct to what Allan said. So we have huge debt, huge deficit. Does anybody know what the plan is to fix the deficit? Because it's not just to devalue currency. Does anyone want to guess? What's that?
Get more in debt.
Get more in debt? Okay, so that's devaluing the currency, right? Does anybody else have a guess? Tax. That's exactly right. The plan in Sacramento, the plan in Washington is increase the tax. Multitudes of various different kinds of taxes. I've been in the rooms when I've heard these proposals that are floated. They make absolutely no sense to me. However, that's the plan. That's what we're going to be facing going forward. So what else does being a real estate investor do for you? It puts you on the right side of the tax code. You now have an opportunity that a W-2 employee doesn't have. You have the ability to write off expenses. You have the ability to offset your income by depreciation. There are so many advantages to investing in real estate over other asset classes. It's not just the defensive play of it maintains its value, it kicks off a dividend. It puts you on the right side of the tax code, and you can argue whether the tax code is right or not. It's not likely to change. The only thing that's going to change is we're going to see an additional increase in tax rates. We're going to see an increase in the types of taxes that are going to be created. We're seeing an attack right now. So if you're a small business person, if you're someone who's trying to accumulate wealth, you're under attack. You're basically being persecuted in this country right now. So as we were talking about before, what does that mean? Like, what kinds of taxes are we looking at increasing? So I'm the tax guy. Let me talk to you about the taxes that are being floated right now in Sacramento and in Washington. They're looking at doing away or minimizing the estate tax exemption. So everyone understands that you work through your entire life, you pay income tax on the earnings that you receive. At the end of your life, when you're attempting to pass on your wealth to your children, there's another tax that applies. You don't get any credit for the fact that you paid tax your entire lifetime at 40 or 50% in this state. It's another tax. The rate right now is 40%. The exemption from that tax is $5.45 million. The plan in Washington right now is to reduce the exemption to $3.5 million and to raise the rate from 40% to 60%. The rest of the country doesn't affect the rest of the country. The flyover states are not affected by this. It's the people on the ends of the country that are affected by this. It's people who live in this neighborhood, it's people who are here, it's your parents that are affected by this. There's another proposal right now to make a capital investment in the youth of America by quote unquote, beefing up the inheritance tax. There's actually a proposal to increase the inheritance tax and take that money and give $10,000 to each person who turns 18 years old in this state or in this country. Give $10,000 to an 18-year-old. You know what, as an estate planning attorney, that's the worst idea I've ever heard in my entire life, right? Someone comes to me and they want to leave money to their kids. What's the answer? In trust. The next question, how long? As long as we can do it, right? We don't give money to 18-year-olds because there's not going to be a capital investment. These are the plans that are being floated, and it's not going to get any better. So I just wanted to kind of add in, what's the solution? The solution is devaluing currency, increasing taxes. You got a question? I'm not even the moderator. I'm just going to go for it. Yeah. Let me hear it.
America having so much debt, where do you guys actually see interest rates? Do you see interest rates going up and going up dramatically in the next 5 years?
So we've been saying for the last 4 years there's nowhere for interest rates to go, right? We've gone from the zero or the low interest rate environment of Alan Greenspan to the zero interest rate environment of Janet Yellen to the negative interest rate environment of, I don't even know who we have right now. But do we think they're going to go up? That's basically what we've been predicting, that they're going to go up every single year. And 4 years ago we said 18 months. 3 years ago we said 18 months. 2 years ago we said 18 months. It's going to happen. We just don't know when it's going to happen. So what are the actual logical factors that affect an increase in interest rates? The economy, right? And so all the factors that we've been talking about, shadow stats, real GDP, real inflation, unemployment, none of the factors actually support an increase in interest rates, right? But eventually it's going to happen because the U.S. is running out of monetary policy and tools. So what's going to happen is there will be a rise. Right now, the Fed's floating, I don't know, for the 20th time, they're saying in December we might see a quarter-point rise in interest rates. Does anyone think it's going to happen? The economic indicators don't support it.
And in the past, when they try to do it, we've seen that it doesn't support it. We've seen the market drop when they try to raise rates in the past. You start to see issues like that come up, and there's really no other way to go. They don't have any more tools in the tool shed other than what we were talking about with negative interest rates, which, at some point, the convenience of having your money in a bank and using it that way stops when you're paying, negative interest rates.
I'm going to say, I actually don't think that rates are going up for a long time. I think if you look at Japan, they haven't really gone up in a long, long time. And I guess you can argue that putting them up 25 basis points is technically increasing them, but to me, that's not really an increase. That's not what I'm thinking as far as what an increase would be. And I don't think our economy can afford to have an increase in the short term. And even if they do, I don't think they can push it up more than 25 basis points, and then there'll probably be a recession anyway, regardless. And then I don't think we're going to have an increase in rates if there wasn't an increase in rates for a decade or two or longer, I would not be surprised. Now, I'm not saying that's going to happen because I can't predict it, I just wouldn't be surprised. I think what I actually said in the past is that even though I don't think that there's going to be an increase in interest rates for a long time, as an investor, if you're going to try to be defensive, you have to assume that there'll be an increase in interest rates at some point to at least protect yourself from the future or from the possibility of that happening in the future, which is a very important point. I realize I'm kind of saying two things at the same time. You may want to act as if there might be interest rate increases, but you may not believe there may be, which if you want to be very careful and be more conservative.
California is very sensitive to interest rate changes, where Oklahoma, we're not be, right? From a real estate perspective.
It's an economy of scale,
Yeah.
right? So you're only talking about maybe in Oklahoma, a few $100 or a few $1,000s.
Exactly. Yeah, so I mean, even a small interest rate in California could be catastrophic, but it will have no effect on the average state of the United States.
Yeah, when I was mentioning the note, I meant from a macro, economic, not from a real estate perspective
Right,
necessarily.
okay.
Yeah.
So let me clarify. I've been saying for the last 4 years are going up. The last 3 years are going up. I've been saying 18 months. I don't want to attribute that to Jeremy or Allan because it hasn't been correct.
Well, they've been drifting up in the last couple of months. They have been.
So you were right 16 months ago.
By a quarter point, not even worth busting your lock rate, right? So,
But there is a difference between real estate interest rates are set by the bond market. Primarily you can read it through the 10-year bond, where the Fed fund rate is actually the rate that money is borrowed between banks overnight. And so it is an influence on the bond market, but it's the bond market that sets the real estate interest rate, not the Federal Reserve per se. Right? The Federal Reserve is an influence on that market, but they do not control that market.
they set perceptions.
They set perceptions, exactly. And then they actually, the Federal Reserve, they talk about jawboning the market, which means they go out there and have a little chat about it.
Which they do ahead of every meeting that they have.
And that's why the data is skewed as well, right? Because I mean, they're setting that expectation. I mean, real unemployment is much higher than they're saying.
Yes.
Real job growth is much lower than they're trying to pretend it is. There's a lot of falsehoods out there in the data.
Yeah, like Jeremy's talking about too, the quality of the job matters too, right? If the jobs that are created are $15 an hour jobs, it doesn't count. It doesn't do that much.
There's a
We have
question.
a question over here.
Right there.
Well, you guys lost me ever since you started talking about interest rate. But on the real estate front, what we're saying is that this country, in general, real estate is a good investment over the long term.
Yes.
And I'm a real estate investor, so in this cycle, I've done a lot of that, I made money. But I feel in California, at least, we are probably close to the top rather than the bottom. So I'm asking you folks, for your existing investment and for your new money, what kind of action are you guys doing at this junction?
Right, so the question was just now here in California that he feels like we're more towards the top of the market versus the bottom. So what types of investing you're asking are these guys looking into, correct?
For your capital, also for what you have, would you unload some of them just to reduce your risk?
Yeah, well, I know you kind of talked about that already. But
Yeah, I just want to make a comment though. So, because at the beginning, I didn't really comment on the what really affects the real estate, and the one thing I would have responded is probably affordability, right? For single family, and are you referring to single family or commercial? Both, because they're different, right? And actually, they behave differently. But on the single family side, I would argue that based on where we are in affordability, and not necessarily in a specific area, but in California as a general statement, we're actually not that close to the top quite yet. Like if you just look at, I'm just giving you objective, like affordability is at 31, and usually nothing happens that's really bad until we're at 17. So, and it doesn't usually jump by like 6 points in a quarter. So, we're at least probably 1 or 2 years away from the top looking at it that way. It's hard to say for sure, but I'm just giving you some generalization. But to answer your question about where we're investing, which I'm sure everybody will have a different answer. I mean, I actually, this year, I've been focused very much into oil. I know probably a lot of people don't know much about oil in the room. It's a real estate meeting, but it's essentially 2009 for oil right now. And if you think of it that way, like I've actually invested in 2 deals this year that were basically short sales from banks for performing assets. Because oil prices have dropped, people got over-levered. It was literally like 2009 for oil. So that's one really interesting place, I think. And if you get the right deal, even if oil prices go down, you're still fine. And then the other thing I would answer is the stuff I'm looking at will make it through a recession. Kind of the point I was making before about I look far ahead. And so what I have to worry about is whether a recession's in 2 years, 3 years, 1 year, or 2 months from now, it doesn't really matter. I have to invest in something that's going to make it through a recession well. Like a mobile home park, self-storage, those are the 2 most immediate ones that come to mind. retail strip center that has the right anchor tenants like grocery stores, pharmacies, those make it through recessions. So those are some good examples. The problem is, even on the commercial real estate side, everything's really, really expensive. So you have to be really careful buying into those even. So it depends on your ultimate goal, you know, whether you're looking for cash flow appreciation. But I'd be very careful you're looking for appreciation right now, especially on the commercial real estate side.
Can I just comment on the unload question? So your question was, should you be unloading property that you own right now? Some of it. Well, the issue is if you unload, what are you going to buy, right? What are you going to roll into? And unless you're going to 1031 exchange or something else.
You wait.
You wait. Okay,
Yeah.
so you sit on the sidelines and you wait. Okay, I suppose that's one alternative. I've seen a number of people unload in the last year and be very, very unhappy unloading because there was nothing else that they were able to turn around and reinvest in. You may be waiting for some period of time. So you got to be very careful. The question in real estate when you unload is always, what are you going to roll into, right? And if you're in a 1031 exchange, you're not waiting long, right? You may have a taxable event when you unload that property.
Right, so there are, other investor groups, they advocate in different part of this country, they're running a slightly different phase of the real estate cycle than California, like Cleveland, like Tennessee, or maybe Florida. So do you guys will even consider that since the out-of-state remote management probably will be more difficult?
Wherever you're at in the country, I think it's important to make sure that, if you are going to hold something longer term, that it can withstand that downturn. Like if you can you accept a 20% drop in rents and still be break even on an asset like that? I personally invest in a more stable market than, a California market. So more stable markets. On my flip side, I'm trying to go lean on inventory. I'm not trying to go into some really long-term build-out project that's going to take me a year to finish the construction on it. That seems to be a bigger risk than something short-term where you're in and out in 6 months or so. I think there's still some room to be able to do those types of flips. Even here in California, you're taking a little bit more risk here in California, and you need to make sure you counterbalance that downside risk. But putting it into, I invest in cash flow assets. I also, I'm a little biased, obviously, because that's what I do. At the same time, I feel like one of the reasons why I stick with that versus doing other asset classes a lot is because of the stability approach to that, where worst case scenario, if I can't flip a project, I can rent it and still have a backup plan where I'm still stable and not going to lose that asset in the long run. So any asset I think that you're going to try to invest in, if you're going to go liquidate, make sure that you have other assets available that you can put it into, because you definitely, in my opinion, you don't want to lose that interest and that revenue increase. We don't know when it's going to crash. What if it takes another 3 years or so to crash? We have an issue there, right? So, I feel like it's the stability of the asset, something that no matter what is going to make it through the next upcoming recession that will come at some point. And the longer we wait, the bigger that recession will be, because it's just, getting ready to explode in different areas. It depends on the market too. So you want to analyze the micro markets, like what Allan was saying, and say, which markets do I feel in the next 10 years are going to have major, major stability, plays in those markets. So, question here.
Jeremy, where do you see, when the next recession hits, where do you see market caps going in commercial real estate, especially for like recession-proof asset classes like mobile home parks, self-storage?
Yeah, so just for those of you who aren't familiar, cap rate is essentially an inverse multiple of the value of cash flow of a commercial real estate asset. So in other words, if you're buying something at a lower cap rate, you're paying a higher multiple. If you're paying a higher cap rate, you're paying a lower multiple of the cash flow. So the problem with cap rates is that they're obviously local. So cap rate will be different here than in somewhere else in the US. And then the cap rates are also interest rate sensitive. And so one thing that I'm trying to sort out, frankly, is that as cap rates have come down a lot, that means the value of properties have gone up a lot. How much, once we have a recession, if interest rates go down further, how much is that going to offset the possibility of properties coming down? Because ultimately, one of the components of cap rate is interest rate factor. So I think that's a really tough question to answer because of that. And I used to personally have specific, and I still do have specific cash flow targets that I look for. But I've been rethinking it just because with interest rates in the long term coming down lower and lower, it's less realistic to actually have the same level of return. It's just not possible because people are willing to actually take lower yield because their cost of capital is lower and lower and lower. So I think that's going to be one of the really tricky parts coming out of the next recession and seeing where cap rates are. I don't think they're going to end up back in the range that we're used to seeing, at least not from when we looked at it a number of years ago, just because I personally think that there's too much downward pressure on interest rates. But I can't really answer your question specifically because it would depend on the market, the type of asset class, even the type of asset, like the actual ABC class of asset, type of asset, the location. Does that make sense?
Yeah.
Question.
It seems like this real estate cycle, there's just a lot more money for investors. I mean, it's like cash from foreigner, cash from wealthy people. Whereas the last bubble we had, it was way over leveraged. People are bank were lending to, you know, just the no-doc loans and all that. So I wanted to get you guys' opinion on what do you think is the worst case scenario of this correction? To me, maybe I'm naive. It just doesn't sound like it's going to be that hard of a blow.
The thing you got to understand about the money flowing out of China is the people in China that are most familiar with what's going on are basically scared shitless, and they're putting money in Irvine. They're just parking it, and they don't care if it goes up or down.
Right.
Right, and that could stop in a day. Right, the Central Bank of China is called the PBOC, the People's Bank of China, and they could literally cut off that money in one day if they decide to do that. They know the money's flowing out, right? They know it, and people are getting it out. And so you've got to look at the sustainability of that, you know? So
But it doesn't seem like it's
it never
gonna be
okay,
as strong of a
talk
blow,
to any
like
talk to any seasoned real estate investor like a Mick Blackwell or Bruce Norris or whatever, right? Before it changes, it always seems really like everything is fine, right? It's because, and the reason is when you're in a market, it doesn't matter what the market is, whether it's gold, silver, real estate, whatever, right? When you've got people, you've got investors coming into that market, right? So you've got fresh money, you've got enthusiasm coming into. But once you get to like 90% bullishness, where like almost everybody is bullish, there's no more fresh money to come in, right? So in economics, it's called Hyman-Minsky's instability hypothesis. And it's very famous in economics, and all it says is that stability itself is destabilizing because what Jeremy said, every year people have to take more risk to get the same return. So it gets to this point, this critical point, and then it just breaks down. Just think of back in 2006, right? And people were saying real estate's the greatest investment in the whole world. And they said it just before it exploded. And it's like that every single time.
Yep.
Right? And one of the signs of this top is that the number of sales reduces. That happens every single time too, right? So people are trying to get $1 million for a starter home in San Francisco, and everybody's in. There's nobody left else to come in. So the price doesn't drop, but the number of sales drops because they can't get $1 million. Nobody can. How much money do you have to be to get a starter home for $1 million? You have to have some money, right? And that's literally what's happening in San Francisco right now. There's no more money to come in to buy a starter home for $1 million. So it's this time this year compared to last time this year, sales are down 10%. That's significant.
Can I just add that? So if you want to see the worst case scenario, you could, I mean, it's still unfolding and it's a little early. You can take a look at Vancouver. Vancouver was the highest propped up of any foreign money, essentially. I mean, I shouldn't make that blanket statement, but it probably was the highest propped up, not 100% sure. And the government imposed a transfer tax to stop the flow of money coming in. I'm talking about in British Columbia. And it just, right now, everything is just free falling because the money that was there that was propping up to these ridiculous prices is gone. And the rest of the market's now just coming into like where it should have been. So you should watch for the next few months and see kind of the worst case scenario, but understand though that there's only a few markets in the US that money is really coming into in big ways. And some of them have already been cut off. So, you know, this year, I'm not sure if everyone's familiar, but this year in January, I believe, the US government actually changed the laws so that somebody couldn't hide behind an LLC as a foreign investor and actually be anonymous. So people can no longer really launder the money without being able to be found, at least who was behind it. And that actually immediately caused the market to shift in New York, in San Francisco, in Miami, those three specifically, just from that alone. If you take a look at New York, you'll find another good case study. Now, so it's only specific markets. Now, just to answer your question about the macro economy, you know, normally after 2008, we had this debt-fueled recession, And normally after that happens, assuming you have some type of debt reduction, the next recession is actually not so bad. But then the one after that can be worse again because people have had enough time to get enough debt to make it worse again. This time around, I think, I like to still believe that's probably going to be true just from extrapolating the past. The wild card is just the rest of the world and also other debt that's been printed and all these other factors. It's hard to say, but I'm personally thinking that the recession won't be so bad only because they're going to look for more ways to prop things up, and they're going to come in and probably start buying stocks with government funds and doing other things to kind of deal with consumer sentiment and try to keep it chugging along. But that's something you have to kind of research more to come up with your own opinion.
Also in Vancouver, the median price dropped 20% in 2 months.
Yeah, it's crazy. I was just there. It was unbelievable.
So that's what happens when you're in a bubble.
Right.
Right?
And
In
you know,
history, we've been studying bubbles in economics for 700-800 years of history. There's not one single example in human history of a bubble that deflates softly. All bubbles burst, and that's what happened in Vancouver. We could have had this conversation. We could have been in Vancouver sipping some coffee, saying, "Oh, everything's fine, everything's great," and then 2 months later, the median price is down 20%.
and all this Chinese money that is coming in here. I've talked with multiple people that deal in that space substantially, and they're paying 20% to get their money out of the country. That's how afraid they are in that country. And the government is starting to crack down. There's been major articles and things like that, primarily written by the Chinese government, that is literally saying these evil investors and corporations are forming LLCs to get their money out of the country. So they put a $50,000 limit per person to get their money out of the country. And it's still coming here underground in that way. But the government could stop that in an instant. And if that happens, then there's, could be some major issues that could happen from that.
Like Jeremy says, it could be the government on either side.
Right.
It could be the PBOC in China saying, we've had enough of this crap. Or it could be the local government saying, we don't want any more of this foreign investment. It could be on either side.
Right.
Go ahead. I guess my point is, since these investors are coming in with so much cash to buy the property, I mean, they can absorb like a drop in price of 20% or whatever, whereas before it was over-leveraged buyers, and all of a sudden they have upside-down mortgages and the cash flow wasn't there, et cetera.
All you have to do if you're concerned about that is just avoid the markets that they invest, because there's only a few markets that they're actually really looking at.
And in China specifically, a lot of these people that are coming over here with this amount of money, they're new millionaires. They've invested in property out there that's gone through the roof, and they have all their money in property. And now they're getting it out of that country to move it here. And so you see some issues with that occurring as well, where they don't care. Like you said, if it drops, it's all cash. They're like, let me get my money out of the country as fast as possible. So we had a question from Gina, and then we'll come over here.
Yeah, thanks, Matt. So I basically have two questions. I'm glad we're talking about Vancouver. So the first of which is on the mining sector as a whole and where we are in this kind of cyclical market, with the debt being what it is, and what is your opinion on the mining sector that has dropped about 90% in the last 5 years? It's pretty much what oil and gas is.
Right. I was going to say before there was the name of the game as an investor is to buy undervalued assets, right? And not to play in markets where they're like Jeremy's saying. Okay, the Chinese money's in Arcadia and Irvine, right? You don't buy anything in Arcadia and Irvine for long-term appreciation. You're not going to get it, right? So the only major asset class that's undervalued is commodities. And what's really interesting about commodities, and I'm very, very bullish oil, right? Because the world needs oil. The world needs lithium. The world needs uranium. And the world needs coal. We need all those things, but all those things are undervalued. So they're all good things actually to be involved in. They are, because like you said, like coal has come down 90%, gold's come down a good 60%, silver's come down quite a bit. It was $50 an ounce, it's now $18 an ounce. So commodities are a very good thing to be bullish on. Now, that being said, a recession takes down everything, right? So a rising tide lifts all boats, a falling tide pulls all boats down. So oil's right now is $50 a barrel. Could it drop again to 27, 28? It may drop into the 30s again, but long term, oil is a beautiful thing because electric cars aren't basically going to take over. They're 1%. They're 1% of the amount of cars. So they're not that much. So it's a very good thing to be bullish. Another good thing to be bullish is biotech. There's some really interesting biotech plays out there. But I'm bullish, say Midwest real estate, but not bullish California real estate.
Okay, and the second question is on the referendum in Italy for December 4th of whether or not they're going to come out of the EU. What is your opinion if they come out?
It's just a matter of time. It's just a matter of time.
Look, actually, let's spend some time talking, and then we'll get back to your questions here. But I know one of our questions we did talk about is other global markets that we think are going to have an impact on the U.S. market. I know Europe is one that I think all three of you guys have expressed some concern about. So let's talk about that.
Well, there's 6 countries in Europe that are very, very anti-EU, and there's only just a matter of time until another one of them pulls out. So Brexit was a big event. The stock market didn't think it would. Well, it dropped 1,000 points in 2 days, and then it came back like, oh, okay, everything's fine. The central banks have our back, right? But it's a big event because Great Britain's the 3rd largest country in the EU. It's good for Britain because now they don't have to abide by all the rules in the EU. So all the nanny-crack rules coming out of Brussels don't apply to Great Britain now. They've regained their sovereignty. They can actually turn their island into a tax haven. So long term, it's very good for Britain. So if all these countries leave the EU and things go good for them, right? So like Hungary, Netherlands, Italy are all looking to leave the EU. Greece is effectively bankrupt. They give it money, and then they give the money back immediately after they give it to them, right? And then you've got Spain and Portugal, right, and Ireland that have got, basically got these huge debt problems. So you've also in France, you've got an election coming in March. There's a woman there called Marine Le Pen, and her numbers are looking very good, and she's extremely anti-EU. So France is the 2nd biggest country in the EU. So if any one of these things at any point in time, the euro could cease to exist, and then all contracts written in euros would have to be rewritten. That's very disruptive, obviously. Right? I mean, it's great for attorneys.
So Dave,
It isn't like it's a bad thing.
Dave, to your point though, the problem with any of that happening is a contagious effect because, without getting into too much detail, a lot of the banks that we have here have made investments over there and are in certain deals over there, and if things happen in these countries, they can be very majorly effective, which in turn could actually reduce liquidity for us here. And so it's something definitely that you have to watch. It sounds like, oh, France might leave the EU, great, but it actually could have a really big effect on us. And actually, it itself could be a catalyst for a recession here, for example, a major event.
Question here.
What do you think about the younger generation coming up and how they impact the apartment market and millennials?
Well, the data on the millennials is that they're not forming households at the same rate that older people did. It used to be in the 50s, 5% of people would have babies out of wedlock. It's now 44%. The millennials are very, if you talk to them, they like to move around. So they like to rent, and some of them don't even have cars. They take Uber everywhere. And also the jobs that they do are very exciting. Like they do startup jobs, and Venice Beach is now called Silicon Beach. There's all these startups in Venice Beach, and it's all full of millennials. They run on it, and they like to travel, right? They like to have a good time, but they like saving money by not having a car, and their income is not what it is, and they're just not forming families. They're not having babies at the same rate, and long term, that's it's probably an issue.
I think that one of the challenges with apartments right now, though, is regardless of what you think about the potential future demand, and I guess that's a major statement, probably too big to say regardless, but apartments have had the biggest run-up. They were the first to start coming up, and therefore you can argue they're one of the highest inflated asset classes on the commercial real estate side right now. So, even if you believe there's going to be sustained demand in apartments for a very long time, there's an argument to be made that this could be the wrong time to buy in from a pricing perspective. But if your horizon's 30 years down the road and you want to keep building for 30 years, it's probably going to be just fine. So really, it depends on what you're trying to accomplish and what you're looking for, but it's something to note is the fact that they're very, very inflated pricing right now.
But rents are still on the rise, I mean, I don't know how that equates to that, because rents are going up and up, and there's a demand problem and also a supply problem.
I don't disagree with that, but with the amount, I mean, maybe you guys have your opinions, but with the amount that rents have increased in the past few years, the only way I can see rents going are the acceleration of rents have to slow. It can't keep going. You can't, people cannot afford the continued sustained increase in rents. So, and that's actually, and that kind of went hand in hand with the apartment prices going up.
Which also ties back to the average incomes people are making, which seems to be flat for so long, right? So
Yeah.
rents can go up if jobs are going up and incomes are going up, but all that staying flat, eventually that stuff starts to top.
Rents have to slow. They have to slow because they've just been on a tear, and it's been a very special situation. The special situation is everybody wants to rent, no one wants to buy.
We're
So
also,
the
we're also in a
demand-
bubble here in California too, though, as far as rents go compared with the rest of the nation.
Yeah.
A lot of the other states in the nation haven't had I mean, certain markets have, but a lot of like the Midwest markets, I haven't seen a giant increase in
No.
rents in like Memphis. It's a slow, steady, incline, but nothing major, So I think like here in California, people are buying it 2 and 3 caps for trophy properties for, multifamilies and things like that. It's crazy.
When we have a vacancy in Long Beach, we'll put an ad out in all the thing. We'll have 30 applications within 24 hours. It's unbelievable.
So there's a
I've been
big
doing this for
demand
20
issue.
years. I've never ever
Excellent.
seen it like this.
Wow.
I mean, you'll have 20 applications and then you go through them and you pick what you want. It's unbelievable. Everybody wants to rent, nobody wants to buy. It's a very special situation. There's not much room for rents to move up. They're going to stabilize, and they could actually, every recession, rents fall.
But see, that's confusing to me because if you have 30 applicants, I have a family that owns apartment buildings for a long time. And, if they get 30 applicants coming in, that means it's time to raise rents, right? I mean, if that's the case, right?
Yeah.
So, I mean,
Yeah, but I think what
We have-
I was gonna say what you're forgetting is that, if we have a downturn, now rents are relatively sticky, which is a good thing. In a recession, they don't come down very much. But at the same time, they can shift very quickly. The sentiments surrounding rents and what people should, it's the same thing as the price somebody should be paying for a house. It's the same concept. So the problem is that can shift very, very quickly. Even if the supply and demand is still not in balance. So.
This is just for Allan, based on kind of an earlier topic. It sounds like you've done a little bit of research on autonomous cars.
Yes.
And I think speaking for a lot of real estate investors in here, you see gentrification in the Arch District. There's the small lot subdivision ordinance. Even Manhattan Beach, you have to have guest parking spots.
Right.
And there's been discussions in my office of autonomous cars
Yeah.
wiping out parking with
Right.
maybe people who own higher density, things of that nature.
Right.
How fast do you see autonomous cars taking over?
Okay.
Because I feel like that could drive people saving $1 million on subterranean parking,
Right.
wait and build, or
Okay.
turning that over.
Here's in a nutshell. So Uber right now is losing billions of dollars to try to be the first company to have driverless taxis. So they're going to be in Pittsburgh, and they're going to give everybody in Pittsburgh a free Uber driverless car for about a week. So the technology is very interesting. It's getting there, but the regulations are way behind. The government doesn't even know anything about this. So Google's working on it. The best minds in the whole world are working on this issue. They think they're 2 to 5 years away, and you can certainly use this technology for trucks, right? So when you go to Las Vegas, you do that. But there's all sorts of issues. Like if someone was able to hack the server, it would be spectacular. If a terrorist was able to, you could have a car crash with 10,000 cars.
So do you think, if this is this a real technology in 5 years, 10, when does it actually get used?
Well, they're saying 2 to 5, but it's hard, right? Because there's all these issues that they're solving. Mind you, there's about 18 companies that are doing this. Fiat, Ford is right in there. Obviously Tesla. So they're working on it. So it's going to be interesting to see how it unfolds. But there could be some issues, right? In Florida there was a Tesla. All this stuff works on light refraction. And the light refraction wasn't good, and the Tesla just ran right through a car like it didn't exist. Tesla stock dropped 20% in one day. So there's all sorts of technological issues, but on the other side of it, the best minds in the whole world are working on this issue. So you kind of have to sort of say at some point they're going to figure this out.
we have to realize too that technology is going to completely change the face of everything we know today, right? I mean, look at China and their printing houses, right? I mean, if they can print a house for $5,000, how much is our housing really going to be worth in the long run here? I mean, this may take 30, 40 years to implement something like that, but it may not. You know, there's going to be, you know, Jeremy in a lot of his investments tries to focus on, you know, when he's doing commercial investing, he focuses on tenants that he doesn't feel are going to be able to be, you know, disintegrated from current technology that's out there and things like that. So looking at that aspect, I think is really important to continue to focus on what technology we at least see today to try to gauge your investments along that.
Robotics is going to be huge, right?
Yeah.
So when a Tesla is made, not one human hand touches the assembly line. It's all robotics. When you order something from Amazon, not one human hand touches that, right? It's all robotics. So robotics, that's going to be a big story, and that's inevitable, and it's going to be in the Midwest.
Yeah, I want to add, like, the way I see it, the two things, if you're a real estate investor, depending on the type of real estate you're looking at, the two huge things are going to happen in the autonomous cars and robots. And autonomous cars, you know, what's so interesting about autonomous cars is that the average car in the US is actually only used 2% of its capacity. It's 2% utilization of an average car. Isn't that amazing? So, like, you know, my car sits, I work from home, my car's probably even lower than 2%. It just sits in the driveway all day and night. And so I think that's going to completely change things. And it was a great question you asked. It was really interesting, actually, how it can affect real estate. And I think robots too. I think you really need to start thinking about that longer term, because a really good example I like to give is, and this is I've made this up. I have no idea if this is ever going to happen, but you know, you've got Domino's in all these strip centers, and they need to be close to where they're delivering, but they've got the cost of retail front, and presumably they're probably not getting many pickup orders. At some point, there's no reason why they can't be in an industrial building that's cheaper, with robots putting everything together. You're going to lose jobs, and you're going to have tenants pull out of these retail strip centers that are those types, right? And also delivery, same thing. Maybe even through autonomous cars, right? People, you know, that won't involve people. So there's going to be a huge labor shift on the robot side that can impact different types of real estate in totally different ways you may not be considering it. And kind of like the internet came through and, basically just pulverized Best Buy and a lot of the centers they were in, and it happened very quickly. You've got to really think ahead, and it's probably going to happen. In my opinion, you know, robots and autonomous cars in about 10 years, you've got to be really worried about them. We don't know how many autonomous cars will be on the road. For sure, robots will have taken up a number of jobs by then. You don't know how many, but you got to basically invest as if it's going to happen, just to be careful. So if you haven't thought about those two items for the next 10-year horizon, you really need to be thinking about that carefully, along with the internet and what effect that'll have on more retail sales and shipping at home instead of people going out. Those three topics combined will affect real estate in many ways.
Steve, I got a question that I'm going to start with you that I'm shocked hasn't come up yet, but we have an election coming up in almost a month from today. And without getting into politics and your preference, I'm curious to know what the people that you're dealing with, do they see something monumental happening after this election is decided one way or the other?
Wow, that's a tough question.
Who are you voting for, too?
Yeah, specifically. You want my ticket all the way down the hill?
No.
So, you know, interestingly, there's a disconnect, I think, with a lot. See, when you say my people, I assume you're talking about my clients and how they're voting.
Correct.
And what their expectations are. Sometimes there's a disconnect between a lot of my clients' personal economic beliefs and their selection of candidates. And I spend a lot of time sort of trying to understand why people believe what they believe and why they vote the way they vote. And I've come down to the realization that you can't explain it. To some people, it's religion. To some people, it's just dogma. To other people, it's passion or belief. I don't see any rhyme or reason between my clients and their political beliefs in a lot of cases. Some of my clients really are, I put them in the category of true believers. They really believe what they believe, and they put their money where their mouth is. And then I see other of my clients who are not true believers. They say one thing, they have one public position, and they have a private position, right? Some people have heard that recently in the last couple of days. So where do I think it's going, and what is everyone planning for? You know, there's a great deal of uncertainty what's going on. Did anyone here read my blog today? No one. It's the best blog. Thank you. It had hyperlinks in it too, but they lost the hyperlinks somewhere in the email. I'm not sure how that happened. We talked about everything. We talked about economic cycles, the length of the economic cycle, the longest, the shortest, where we are right
You
now.
even made up an acronym.
I made up my own specific term for the greatest election ever. What did I call the TMBB? The most entertaining election ever, or something like that. So we're in a really unique situation. Like literally every single day something unique is unfolding. There's a great deal of uncertainty in the world. I will tell you what my clients by and large are doing. A lot of them are sitting on the sidelines. A lot of them are holding cash. A lot of them are sitting on large portfolios or large amounts of cash waiting to invest their portfolios. I want to address what you said earlier, which is it seems like there's a lot of money sitting on the sidelines and it seems like it's harder than ever to get in. I promise you, for my clients that started in the 60s and the 70s and the 80s, they all thought it was harder than ever to get in at that point in time. But they picked the right property and they got in. They picked a point and they got in and they held on. And that's where they built a lot of wealth. So don't be discouraged that it seems harder than ever. It might be harder than ever. But there are other markets. It's not all like it is in Arcadia or Irvine or Manhattan Beach. There are other places that you can invest. I think their key to success was tenacity, right? They got in, they held on, they leveraged up what they had, and they were able to grow it. I assure you, I have an 82-year-old lady who lives in Palos Verdes. I love her. She's one of my favorite clients. She and her husband started out as school teachers. They were third grade teachers. They had probably nothing. They got a small, I think they got a 4-unit to start with. They lived in one of the units. They rented it. They painted the building. They did the plumbing. They did all of it together. They, when the husband died, had 156 units, right? So they were able to leverage up. And I'm not talking about, I'm talking about A-class good stuff. They had a lot of great stuff when he passed away. So the other thing we've talked about is there's been a lot of money made over the last 4 years where we've all been talking about, oh, this correction is going to happen. You've got to be very careful how you buy in. There's been a lot of money made. There's been a lot of money made by people in this room, and people in this room have seen opportunities and they've seized on those opportunities. One of the things that lawyers do is we suffer from analysis by paralysis. We will figure out all the reasons why something won't work. And intelligent people do that. One of the things I struggle with is I try to figure out what are the characteristics in my clients that have made them so successful. And to my way of thinking, it's not just tenacity. In some cases, they had the ability to ignore that little sense of doubt, or maybe they didn't even recognize that sense of doubt. They bought in, they held on, they were able to ratchet up using all of the benefits of real estate that we talked about earlier. So I don't want you to be discouraged. I don't want you to feel like there's more money than ever and it's harder than ever to get in. I promise you, there are people in this room that started 2 years ago, 3 years ago, 1 year ago, and they've made a lot of headway. They've made a lot of success. What they did is they got started. So you asked me what my clients are doing, I'll tell you what my clients are doing. Anyone who hadn't refinanced any portfolio, so I represent a lot of professional trustees. Professional trustees have fiduciary obligations to make sure that they're putting the assets and the beneficiaries' interests ahead of their own. We've refinanced every single portfolio that we have. I've seen somewhere around $100 million in portfolio refinance in the last year. I have shopped those portfolios to 6 or 7 banks. I've had a lot of fun because it's not my money, right? So I can be as difficult as I want to be to lenders, and I can play them off against one another, and I've had a lot of fun. They've all refinanced. Anyone who hasn't refinanced at this point in time, I don't know what you're waiting for. There are large amounts of money sitting on the sidelines right now. My clients have specific cash reserves sitting around waiting for the deal, but it's not all they are doing. They are also in to the market in other ways, not 100% sitting in cash on the sidelines. They have allocated a certain amount. They've said, okay, this year we're going in this much. This year we're going in this much. This year we're going in this much. Most of them have allocated it in the real estate sector in some way, shape, or form. There are a lot of different kinds of asset classes specific or types of investments in the real estate sector, right? So there are other ways that you can get in. I have had clients be incredibly disappointed in getting out. So the gentleman over here said, should we get out? The problem with getting out is they had nothing else to get into, right? And if they got out, now all of a sudden they have a taxable event, right? They didn't 1031 exchange. They sold, they paid capital gain, they're sitting on the sideline. There's a big difference between not paying capital gain, right? So you're looking at a third reduction in the value of whatever you had accumulated, right? So you got to be careful when you get out, make sure that you have something that you want to get into or it makes sense for you to get out. They are going into, in a lot of cases, real estate investment assets that don't have, which is my way of thinking, and obviously Jeremy's going to have a different opinion on this because he's much more versed in this. But what I'm seeing is I'm seeing a lot of things like mobile home parks. I love mobile home parks, right? Mobile home parks, that's where people land when they don't have any other opportunity or any other choice, right? It's a fairly safe investment. If you're at the top and there's some economic event, people will move out of the top. They will move down. There's not many other places to go below the mobile home park, right? And in particular, I looked at the mobile home park investment in an area in Texas. I won't tell you where it is. And specifically, it was a place where there were a number of military bases, and a lot of people were returning to those areas because they got, through their military retirement plans, medical benefits and other kinds of benefits. And the entire areas were sort of keyed toward providing benefits to former service people, right? So I thought that was a particularly interesting investment. So that's what they're doing, by and large. They're not moving 100%. They're remaining flexible. They're locking in low interest rates right now while interest rates are low. We don't know that interest rates can really go much lower than really are. I'm sure they may be able to go negative at this point in time. But is anyone really going to wait to see if they're actually going to go negative? A lot of people are locked in. So that's what they're doing.
Alan, curious to your point of view on what the impact of the election you think is going to have on the economy.
Very simply, I'm not much into politics, but I don't think politics affects the economy as much as people think. If the Federal Reserve doesn't control the economy, then certainly the federal government doesn't control the economy. So the only thing I would say, it sounds like a joke, but it's not true, and I've said this before. I read somewhere that Hillary Clinton is the most unpopular candidate in the history of the United States, except for one person. That person was Donald Trump. Sounds like a joke, but it's actually true.
I am not a huge believer that politics are really going to affect much, just because everything has its cycles. So, and I'm Canadian and U.S., but I can vote, but I don't vote. But I still think that it's not going to have much of an effect as far as where we are in the cycle today, how long the cycle's already lasted, how much more time we have. And I'm not really a big believer that, assuming it's not someone that's going to have a crazy shakeup of anything, that if not much is going to change, I think. So.
Question from, like in 2011, 2012, we had this massive amount of kind of institutional money coming in buying residential property. What are they doing? Are they still fixing it up? Are they selling it? Are they holding it? Like, what's going on with all those portfolios?
Well, the first thing I can tell you is that they stopped buying. Certainly stopped buying. They stopped buying a little while ago. And I have not, to be honest with you, I haven't checked in because I'm actually in this part of the cycle. I don't really deal much with single family, so I'm much more focused on other asset classes. I just rotate depending on where in the cycle. So I'm not a good person to answer whether they've disposed of a lot or not. I don't know if anybody else knows on the panel.
Okay, so one of their exit strategies was to take the company and IPO it, which means put it on the stock market. That didn't work very well. Another strategy that some of the hedge funds did was try to sell the properties to the people that were renting. That didn't work very well. They still own a lot of it, but they realized that there's pretty much no more gains to be had. So they're trying to liquidate and try to move the hot money somewhere else. So, that's a little bit concerning, because they do, in certain areas like in the Inland Empire, they earn quite a bit, It's kind of like the Chinese money. The Chinese money is in certain areas. The hedge fund money is in certain areas too. You will never find hedge fund money in Huntington Beach, but you'll find a crap load of it in Riverside, California, right?
I read an article just recently in the Wall Street Journal that talked about how Goldman Sachs is starting to look at rental properties quite a bit more at this time of the market, which was very interesting because I thought they were all leaving. I don't know how much, but it was just an interesting play, with regard to this topic that, they thought it was. I feel like some of these bigger companies are still trying to find a way to chase yield.
I know that article, and it was placed by Goldman Sachs so they could sell all their
Was
shit.
it? Okay. There you go.
Just to build on that, I've seen a couple of those portfolios get shopped around. There's not a lot of interest for them.
Yeah. Well, they're trying to sell top dollar and
Right.
Yeah.
Question.
So along those lines with the big investment companies, what are your guys' thoughts about like the rich uncles kind of thing that's going on? Are you familiar with rich uncles?
It's crowdfunding, right?
Yeah.
Yeah.
Well,
I have a friend that works down there in Orange County in there, but I think you have to be a little bit careful of crowdfunding because it's like split in so many different ways. I mean, if something goes wrong, it could be spectacular. I mean, it really could. So I don't know. I'm not really a huge fan of the crowdfunding.
But I've never heard rich uncle term before. Sorry, what do you mean by that?
it's REITs, you know, but being opening up to small investors, $1,000, $500.
And you're talking about the crowdfunding, so
Like
yeah.
Red Plus.
Do you have a specific question about it? I actually am an advisor to Realty Mogul, which is so far the biggest real estate crowdfunding just by volume. And I also am an investor in the biggest equity crowdfunding site that's non-real estate. So I know a little bit about the space, but not a ton, but I still don't know enough. But what's the question?
Well, just how does that play into the bigger real estate investing picture?
Well, I got one, because we actually were on a conference call today. We were looking at a Reg A Plus, putting a deal together. They're so expensive because of all the SEC regulations and everything you have to, put together. We were looking at anywhere from $100,000 to $150,000 to put together the package necessary to do that. Well, at that kind of administrative drag, you need to be raising 10 to 20 to 30, $50 million to do that, and that's really hard to do on $1,000 investors. So the general takeaway we got was that the amount of time and legal time it would take to do that, we're not quite there yet from a market standpoint where you're going to be able to raise the capital necessary to go and buy real estate to cover all that administrative drag. So I'm not sure what type of big effect it's going to have on real estate. Obviously, Realty Mogul, like what Jeremy's talking about, there are some platforms out there that are doing that, but they're smaller portfolios, not super big portfolios that are trying to take it down.
Yeah, I could go on about it for a little bit, but what Dave was talking about is something called Reg A Plus, which is a new equity crowdfunding that was allowed as of last year, and that's one type of crowdfunding. It is expensive to do. Mostly done more by startups and not real estate, although some of the e-REITs that you're talking about are actually Reg A Plus, up to 50 million. But I think the more common, what they call crowdfunding, which isn't really crowdfunding by definition per se, is like Realty Mogul may have an offering for a certain building where they're raising $3 million, and it's something called a 506C. And that is something that is public marketing to accredited investors, but it's not really crowdfunding. It's more like traditional fundraising where you're allowed to publicly market. That's a different market, so that's a different thing that Dave was talking about, a different set of costs. It's much lower. What I will tell you though is that crowdfunding in real estate, amongst like Realty Mogul, Realty Shares, and a few others, the bigger ones, they're all shifting to the REITs. And the reason it's shifting to the REITs is because it's much more efficient for them. So trying to have a go at like raising $500,000 here, $2 million there is very inefficient for them. It's from a cost and actually benefit perspective, from a profitability perspective. So they're all testing the waters right now, including Realty Mogul, on trying these REITs, which is much more efficient because they'll go raise 1,000 or 10,000 or whatever from a person, trying to raise up to 50 million, and if they can get that, they can actually allocate 50 million across all these opportunities instead of raising them for individual investments. So if you watch to see what happens with those, if they're successful, then probably you're going to see the whole industry shift to more of an e-REIT type of structure, which will be much more efficient for the crowdfunding sites, and will be, in a certain way, better for investors and be much more diversified, and have certain different types of liquidity depending on the structure. So just watch carefully, because if they're successful in raising these funds now, there's only been Realty Shares and Realty Mogul, I think, that have done it. If they're successful and you see them duplicated and they're successful as well, you'll probably see everybody shift to that method. That being said, I do think that once we have a downturn, you're going to have some of the platforms have some issues with some bad deals. It's just inevitable. And then there'll probably be a lower sentiment towards crowdfunding in general from the average investor. And I think there'll be a period where, like any other recovery, it's going to be like a cycle. So there'll probably be people shying away from them. Some platforms will have to kind of slug through from a dollar perspective, and then they'll probably be a ramp back up. But there'll probably be a lot less sites in a few years from now after we have some type of a downturn than there are today.
I agree, that's probably the biggest risk in my eyes with regard to crowdfunding right now, is you're starting to see, a lot of crowdfunding companies come up there that may not necessarily do the right homework that they should be doing on those deals and the right background checks and things like that. I mean, they have due diligence processes, but not everybody has an advisor like Jeremy to be able to analyze their deals conservatively. So you start to see some of the issues with that, where if there is a downturn, you're probably going to see a lot more regulation coming into that field, because people are going to lose their money from a lot of mom and pop crowdfunding type sites that are maybe not necessarily doing the right homework on their deals. Back to the Reg A type stuff that we've seen on that side. I mean, I talked with a marketing company recently for a $20 million fund, and on top of the $100,000 of legal fees, they want 6% just to market it, with no guarantee that they're going to raise the money. If I want to do that, I'm going to go to a broker dealer all day long and do it that way and get guaranteed money, to come in, instead of hoping that they can raise that much capital.
I just want to say, I should have said that the comments I made about where I think crowdfunding is going and everything do not reflect Realty Mogul. I've been an advisor for them. I'm an only outside advisor. I've been with them since before they launched, and I'm not speaking on behalf of the company. That's just my own personal opinion.
If a crowdfunding site goes down, it'll be spectacular. Everybody will lose their money, and there'll be nothing you can do. Just sunk costs, just be money just lost. So it reminds me of Ernest Hemingway. They asked Ernest Hemingway one time, "How did you go bankrupt?" He said, "Well, two ways. First, very slowly, and then second, all of a sudden."
If you're looking at crowdfunding, there's already deals that have gone bad in crowdfunding. And if you want to read up on them, I know the person who started this blog called CrowdDD, which is crowd due diligence, crowddd.com. And he actually personally, because he's invested in over 50 different crowdfunding site deals, and there's been other people who invested in many, and they all actually discussed on these message boards that you can access what's going on, how companies are handling deals that are going bad. Literally by the minute updates on what's going on, and you'll find some of the stuff there. I will say though that some crowdfunding sites have been able to compartmentalize every single deal, so if the site goes down, the rest of the deals will be fine. They already have backup mitigation of who's going to actually manage those deals and everything. So some of them definitely haven't, but some of them have. So you need to really do the research if you're going to invest in one of those sites, just to make sure you won't have a problem if there's a downturn.
Question?
So we're talking a lot about the recession happening. I'm kind of a young investor. You guys have kind of been through it, seen some different things. I mean, you came up kind of like during the last recession. Can you guys talk a little bit about what happens during a recession, as far as like how the real estate cycle starts to move from like a flipping? And I can kind of see where it's going to go from, I manage some Airbnb, so I can see how that might happen. Like, people aren't going to be traveling as much, so, my nightly rate might go down. But, what will we look at as far as like rentals from a whole, and how do we know that we're getting to that point of recession, and how do we know where we are kind of through that cycle, or where do we go and learn about that?
If we get a recession, rents in Southern California could drop a good 10-15%. Last recession they dropped 20%. So 10-15%. I mean, given the run up in rents and the special situation, you could easily see a 15% drop in rents.
So I'm going to ask Jeremy to talk about this a little bit, because I know that Jeremy does a lot of due diligence when he considers an investment, and I think he's probably one of the best people on the panel to talk about the things that he considers and the factors that he builds in developing a safe investment.
I'm not even the moderator. Who paid you to ask me a question?
You want me to mimic what you'd said before? I'd be happy to do that.
So I want to make sure your question gets answered too. So you want me to try and answer them together?
Yes.
Okay. So, well, they're kind of different questions. So let me make sure I address your question, and I'll make sure I address your question. How about that? So, I think on a general scale, you'll see rents. You'll see stuff basically come down, and then it's probably fair for you to expect things to go sideways for about 2 years. I'm generalizing, but that's kind of typical, and then you'll start to slowly get stuff move up. So if you look at 2008 and then 9, it wasn't until 2013, and that was an extreme recession, but it wasn't until 2013 that stuff really started to come out the gate. 2012 and a half, the stuff really started to come out the gate, so it took more than 2 years. But in a typical recession, take a couple years where you might see stuff go sideways, and then you'll slowly be able to ramp things up again. But at least you have an idea of how long it might affect you. Could be less. I wouldn't expect it to be a tremendous amount more. And if you know that rents can come down, I think Allan's estimated spot on, like 10-15% is typical in this market. So does that answer your question?
I think so.
What, I don't know how to answer your
I
question.
think we could also, well, I think part of what he's also asking about is from an asset class. For example, you're no longer looking at apartments because apartments may have phased out, right? Well, when the recession hits, all of a sudden cap rates are going to start to rise again. You know, the multiple people are paying on income is going to start to move more towards a, maybe your favor as an investor. So I think the amount of assets that you may have to look at, such as single family, some multifamily, maybe some things right now that these guys aren't looking at because of where we're at in the cycle, are going to start to come back into play, which I think is kind of what your question was.
So if we kind of go to that point where the market starts dropping or going sideways, I mean, are people still flipping houses during the downturn, or is it like things kind of go slow down and pause, and then we wait for it to ramp back up?
I'll take one stab at that, because this is, we've done some super high-end development up in Hollywood Hills, which we're not doing right now because of where we're at in the market. So our general point of view is that once we hit that point in time, we want to start acquiring, and we may start looking at stuff that has a longer development window. So even the stuff we were doing recently, we were trying to get in and out from a year or less, but all of a sudden, if there is a major correction, well, that might be when we want to start buying land and maybe building something that has a longer horizon, because now we think we've got the cycles in our favor versus working against us. So that's one of the things that we're looking at is the style of project we'll look at may change depending on where we're on the market, just because we've got a longer horizon or window to play with.
Yeah, I would caution you that, like, give you a great example. In 2009, although it being an extreme cycle, there were some people who came out of the woodwork and started doing hard money lending right away on single family as soon as they started to come down. And they were basically catching a falling sword. And the ones that went down within a year or two were the ones who started in 2009 and didn't have the right loan to values because things went down more than they expected. People who did really well started in like 2010 and a half, 2011, and have just ramped up the entire time and they basically waited until the sword stopped falling. So, if that's one thing I would caution you of, you end up in a position where that could happen in a market as volatile as California. Some other markets like where Matt is in Memphis and stuff, it's a whole different story. That risk isn't there as much.
But I know a lot of people that were still flipping during the down cycle in California, but at the same time, they're counterbalancing themselves and saying, look, if it drops 5% in the next 4 months, then let me put that into my analysis every time. And you actually, in a lot of those situations, when the knife is already dropping or in the process of dropping, you have a lot of people that are more afraid and make the wrong decision and sell you their house for cheaper than they necessarily should be, so you can get those extra 5 or 10% margin to counterbalance some of that downside risk on a short-term deal. You don't want to deal with the long-term stuff where it could go down by 20 or something like that because it's a year project or something, unless you're doing a 2-year or 3-year type project. But you just have to make sure you build that into your cost analysis and say, look, if my comps are going to sell for 5% or 10% less than what they are now, am I at least break even on my profit analysis to make sure that you're not going to lose money at each step of the way?
So, Steve, going back to your question, I'm not 100% sure I understood it correctly.
So let me maybe boil it down a little bit. So a young investor would be thinking, okay, maybe I see an opportunity, but how do I develop whether this is a safe investment for me, and what factors do I consider in determining what my safety zone is, right? So you talked before about your assumptions about interest rates and where they might go, or your vacancy rates or other kinds of things. Like, what are the 3 top things that you consider important for a young investor to consider as a defensive?
Yeah, so that's a good question. Here's the challenge of the question, though, is that it really varies by asset class. That's the problem. I will give you some high-level stuff, though, so that's good. It's a good question. So I would say, number 1 is definitely make sure you have some padding. I always use that term. What does it mean? It means that, like, I was analyzing an oil deal today, okay? And I was literally looking at the scenario, what happens if oil goes to $20 a barrel? Or actually, what are we assuming oil is going to be after the first year? Right now it's at 51, we're modeling at like 34. That's padding, right? That's like a chunk of padding. So the more padding you can have in a deal from your downside risk protection, to your point, the better off you're going to be as far as probability of success. So that's definitely number 1. And you can actually impose padding in so many different ways. You could do it from a price of oil perspective, you can do it from a vacancy factor perspective. So for apartments, for example, you know, I see a lot of apartment buildings that are 100% occupied, and I see people model them out with 3% vacancy, and I just literally go on to the next deal, because to me, that's just not enough padding. I'd rather see 8% vacancy 1 out of 12 months, right, just for example, which a lot of people won't do because you're bringing down the returns, but you're just at least adding the padding. So if you actually like the returns at 8% vacancy and you have 3% vacancy, fantastic. You know, that's another example. It really depends on the asset class, you know, because a lot of stuff I look at, which is commercial real estate, you've got to pay attention to what actually to the point of rents and apartments before. You know, what are you assuming? Rents are going, how much are going to go up in a year? How much your expense is going to go up in a year? Be very careful with that. It really depends on the asset
Yeah, I
class.
get it. So maybe specifically, what asset class are you thinking about?
Well, I tell you what, let's save that for after the panel. So it's now 25 after, which we've gone a little longer. We got started a little later, but I think we're going to wrap up now. First of all, thank you guys. I know we went a little longer here, but there's just so much questions, big great questions today. Let's start off by giving a round of applause to these guys for all this.